Most founders think if they build an AI startup, investors will automatically be interested, but that's not how the market works anymore. So in this video, I want to break down 10 UK VC firms actively investing in AI, what they actually care about, what companies they back, and the signals they actually respond to. Because right now, there are founders building genuinely good AI companies, but still getting filtered out almost immediately. Not because the product is bad, but because the investor they pitched was never looking for a company like theirs in the first place. One fund wants deep infrastructure, another wants healthcare AI with regulatory defensibility, another only gets excited if your product creates proprietary data over time. And the wildest part is some of these firms can tell within 10 minutes if your startup is venture scale or not. The UK is now the biggest AI investment market in Europe. Billions are moving into this space, but the money is not moving evenly. There is a specific pattern to what's getting funded right now. And if you're fundraising, knowing the names is not enough. You need to understand how these firms think. Quick one, before we start, I have roughly ordered this list from earlier stage to larger growth investors. So if you're pre-seed, pay attention to the first 5. Now, the first one is S Street Capital. There are firms that invest in AI and there are firms that basically live in the AI ecosystem. S Street Capital is one of those firms. Nathan Beniak, the founder, publishes the State of AI report every year and half of the industry reads it like it's required scripture. But here is what matters if you're a founder. S Street Capital is not looking for AI productivity apps. They want technically difficult companies. Think infrastructure, autonomy, tech bio, things that feel difficult to build even for smart people. And there's a question buried underneath a lot of their investment decisions. Could this company have existed 3 years ago? If the answer is yes, your moat probably isn't deep enough for them. That's why companies like 11 Labs fit so well in their portfolio. The broader point here is important. A lot of founders think saying that we use AI is the pitch. For firms like S Street, that's just the starting point. Also, they have recently secured a $232 million fund, and their check sizes are set to range from $500,000 to $15 million. Next is MMC Ventures. This is one of the firms that introduced the concept that I think every AI founder should understand. I'm talking of the data moat. I personally think this is where a lot of AI startups are going to struggle over the next few years because most models will become commoditized. So the real advantage becomes who owns the best proprietary workflow and data. MMC has been thinking about this for years, and the reason why companies like Synthesia became valuable is not just the model, it's the feedback loop. Every enterprise customer interaction improves the system. That's what investors get excited about. Products that become harder to compete with over time. A lot of founders are still pitching features, investors are looking for compounding advantages. Let's talk about Seedcamp, the third company. If you spend enough time around European companies, eventually you start to realize that Seedcamp has been early to an absurd number of important companies. I'm talking Revolut, Wise, UiPath. On the AI side, they also invested in Synthesia, Revox, AI Labs. At this point, Seedcamp is less a VC fund and more a talent detection machine. And what's more interesting is this, they often back founders before the company fully makes sense on paper. And that's important because some funds need traction to believe in you. So far, Seedcamp has backed over 550 companies and they have at least 12 unicorns. Seedcamp is often underwriting founder velocity and market intuition much earlier, which means if you're technical, moving fast, and building something slightly non-obvious, they're one of the most important seed funds in Europe to understand. Their check sizes range from £250,000 to £750,000. Next, Balderton Capital. Now, once you move into Series A and growth stage territory, the game changes completely. At seed stage, investors are asking, could this become important? At growth stage, they are asking, can this dominate a global market? Now, that's where Balderton sits. It's one of the biggest venture firms in Europe, and they tend to back founders with very large ambitions very early. Now, here's the signal I pay attention to. Balderton doesn't behave like a fund trying to build good European companies. They behave like a fund trying to build global category leaders from Europe. Now, that's a different mindset. Wave is probably the clearest example. Autonomous driving, end-to-end AI systems, massive technical complexity, massive capital requirements. Basically, Wave is building generalized vehicle agnostic AI that can learn how to drive from vast amounts of data. And when Wave raised $1.2 billion Series D round, Balderton co-led it. That tells you something important. The biggest AI opportunities increasingly require conviction at enormous scale. This is where many founders also misread larger funds. They usually think if I get bigger or if I get enough traction, bigger VCs will naturally become interested. But that's not necessarily the case. Growth funds are looking for very specific signs: market inevitability, expansion potential, category leadership, and speed. They're also looking for capital efficiency relative to ambition, and these are all different filters entirely. Number 5 on my list is IQ Capital. IQ Capital sits in a very specific lane. This is deep tech territory, companies where the technology itself is the moat. This is one of the areas where the UK is genuinely world class, because the UK produces an enormous amount of high-level research talent. The challenge for these talents and startups has never been intelligence, it's usually commercialization. IQ Capital sits in that gap. Speechmatics is a very good example. Advanced speech recognition, difficult technical problem, long-term defensibility. And this matters because we're entering a phase of AI where wrapper companies are becoming less impressive to investors. That's where firms like IQ Capital become extremely relevant. If your company could realistically be replicated by a smart 3-person team in 6 months, this probably is not your investor. Their thesis is IP-rich, scientifically complex, commercially underestimated, academic, technically hard founding teams, algorithms and infrastructure that took years to build and can't be reverse engineered overnight. So they invest seed through Series B with initial check size ranging from $1 million to $10 million, while their growth stage checks follow on with up to $40 million. Next is Phoenix Scott. Okay, so this is the one people online get wrong. People still refer to this one as local globe. And technically, that's true, but not fully true, because the broader organization now operates under Phoenix Scott Group. Why does that matter? It's because they built one of the most interesting venture structures in Europe. Local Globe handles early stage investing, Latitude handles growth, Solar focuses on later stage, and Basecamp backs emerging managers. Meaning, theoretically, they can back a company all the way from first check to IPO. They're not just looking for good startups, they're looking to build long duration relationships. So that changes how they evaluate founders. And by the way, their track record is ridiculous. I'm talking Wise, Monzo, Citymapper, Travel Perk, which is now known as Perk, and on the AI side, Cusp AI, and Past. But here is a deeper lesson. A lot of VC firms are not just picking companies well. They are designing systems that are allowing them to stay close to exceptional founders for a very long time. Now, let's talk about Octopus Ventures. Octopus is interesting because they lean very heavily into sectors that founders avoid. Medical imaging, climate, deep tech, robotics. Highly regulated industries, high barrier to entry, longer build cycles. There's a reason serious investors like these markets. Hard markets scare away weak competitors. A startup building another generic AI productivity tool might get copied in 6 months. A company navigating healthcare regulation, clinical workflows, and medical AI infrastructure, much harder. That's where moats become real. Their portfolio consists of LV in women's health tech, Wave Optics acquired by Snap. Number 8 on my list is Albion VC. Albion VC feels very thesis driven. The thing about thesis driven funds is that if you fit their thesis, the conversation can move really fast. But if you don't, it doesn't really matter how impressive you are. The conversation is not moving anywhere. Their focus is enterprise software, health tech, cybersecurity, data-heavy systems. Companies solving painful operational problems for large organizations. Quantexa is a strong example. AI for financial crime detection, massive enterprise need, large contracts, deep integration into workflows. Albion first backed Quantexa in Series A and has continued to support the company through its multiple fundraising stages, including its $175 million Series F round, which valued the company at $2.6 billion. Now, this is something you should pay attention to. Investors do not care how impressive your demo looks. What they care about is whether large organizations will deeply integrate your product into critical operations. Because once that happens, switching costs rise, retention improves, and the business becomes much more durable. The next is SFC Capital. SFC Capital has built a model around Seed Enterprise Investment Scheme and Enterprise Investment Scheme. And if you're not familiar with those schemes, you need to learn them quickly because they fundamentally change how early stage investing works in the UK. The government effectively reduces investor downside through tax relief, which means investors can then take risk much earlier. That's why SFC can back companies at a stage where founders have barely even finished the product. A lot of founders wait too long before they start fundraising conversations. They usually think, I need more traction, I need more revenue, I need the perfect deck. And don't get me wrong, these things are important, but sometimes you just need the right investor. So far, SFC Capital has invested in Implement AI, a digital workforce company that deploys teams of AI agents that work together to increase revenue without adding headcount. And the last on my list is Atomical. Atomical is probably one of the most globally ambitious firms in Europe. It's managing $1.24 billion in assets across its latest funds. It is strategically bridging ambitious European founders to the massive US market while simultaneously acting as the primary international co-investor to help US-based scale-ups bridge back into Europe. And their worldview is very clear. European companies should not think small. They want US expansion, massive markets, large outcomes. I want to use one of their investments to make a larger point about AI. And this investment of theirs is GraphCore. At one point, GraphCore was one of the hottest AI infrastructure companies in Europe. Billions in valuation, huge backing, enormous expectations. Their vision was ambitious. build AI chips capable of competing with Nvidia. The company was incredibly respected, but sometimes great technology still loses to market structure. Competing in AI hardware requires insane amounts of capital, not millions, but billions and billions over time. And GraphCorp became a reminder of something that both founders and investors are learning right now. In AI, technical brilliance alone is not enough. Capital intensity matters, timing matters, distribution matters, ecosystem power matters. That's the real lesson. So here is what the list actually tells you beyond the individual firms. The UK is the biggest AI investment market in Europe, but easy money is gone. Horizontal AI companies, e.g. ChatGPT for X, thin wrappers, generic productivity tools, they are getting harder to fund. What the firms on this list are showing us that investors are interested in is proprietary data, foundational infrastructure, or deep tech complexity that takes years to build. Which means the real question isn't just which fund should I approach? It is, does my company have the defensibility that the current market actually rewards? If the answer is yes, know your stage, know your thesis fit, do the research before you reach out to the VC firm. The firms on this list have all mapped your space. You should have mapped them too. If you found this video useful, please subscribe. I create videos like this every week. I'll see you in the next one.